Welcome to Research Recap on JP Morgan's Making Sense podcast. I'm Sam Mazzarello, and I lead content strategy for global research here at JP Morgan. Today, I'm joined by a few of my colleagues to discuss our 2024 mid-year outlook. Throughout this episode, we'll be discussing the key happenings that have shaped 2024 so far and what lies ahead for the economy and markets in the second half of the year. So with that, let's dive right in. To kick things off, we'll hear from Bruce Kasman, our Chief Global Economist. Bruce, thanks so much for being here today.
Thanks for having me.
So, Bruce, what's the outlook for the global economy at mid-year?
The key point to our outlook is that the global economy is moving on to a more sustainable path as it becomes less dependent on the United States, and the base of growth is broadening. At the same time, we think that we're seeing the progress in terms of bringing inflation back down to central bank targets pretty much stall here, not at an unusually high level, but still at levels that are comfortable for central banks. And as a result of these 2 points, we think that the environment is still consistent with limited window for central bank easing, and effectively that we live in a high for long environment for a considerable period of time.
That's very interesting. Thank you for that. As you look to the second half of the year and beyond, what are some factors you and your team will be keeping an eye on?
Well, as we look to the second half of the year and beyond, I think what's interesting is that performance has been more or less in line with what we expected in the first half, but there's some underlying performance gaps that really do still challenge our view. On the growth side, I think one issue is that while consumer purchasing power has been lifted by falling inflation and by still pretty strong wage gains, consumer confidence has remained depressed. The balance of those forces has left a pretty sluggish consumer. I think a second performance gap reflects the fact that profits have been sluggish, even though margins for corporations have remained high. And that's left us with a corporate sector that's remained in expansion mode, but not decisively so. On the inflation side, labor markets have been tight, but have shown somewhat better balance, particularly in the U.S., where the unemployment rate has come up. And as well, we've seen some reduction in vacancies and other measures of labor market tightness. Our forecast continues to be that we stay sticky on inflation, we stay resilient on growth. We're comfortable with that. But there clearly are some things we need to see. And I think from my point of view, the biggest determinant of what is going to happen in the next 6 or 9 months is the behavior of businesses. And if we're right, businesses stay in that expansion mode. And I would argue that if that's the case, then the right way to look at the sluggish consumer is give them jobs and they will spend.
And finally, Bruce, what are some of the biggest uncertainties as we go forward?
Well, I think there's at least 2 uncertainties we should focus on. One is the continued elevated interest rate environment that contrasts with what are financial conditions that have actually been easing broadly this year. This is somewhat uncharted territory in terms of how it influences the outlook going forward. And I think it is something which adds uncertainty as companies do face higher borrowing costs, as balance sheets are adjusting to higher interest rates. But we're seeing equity markets reach record highs. We're seeing the spread markets and credit more generally behave well. And capital is flowing to key emerging markets at this point in time. The second thing, of course, is the political environment, which has a number of uncertainties around elections. Perhaps the biggest one is the U.S. election in November. We think the most important risk around the election would be the resumption of a trade war, which in 2018-19 actually had a significant negative impact on business confidence, had an effect on depressing business spending, capital spending particularly. And if we entered in another one, we're almost certainly going to see retaliatory action elsewhere. And the potential negatives for that on growth, we think, overwhelms some other things that might be happening in the U.S., perhaps on fiscal policy and the regulatory front.
Yes, I expect that the U.S. election will be a recurring theme as we continue to hear from our colleagues throughout this podcast. Bruce, thank you so much for sharing your insights.
Thank you.
Next up, we have Mislav Matejka, head of Global Equity Strategy. So, Mislav, what are some of the key factors for the equity markets at mid-year?
The key for the outlook is really this trade-off between growth and policy. In the first half of the year, there was a positive trade-off. The expectation was that central banks would be easing for the right reasons, for the falling inflation. And at the same time, the view was that the improvement in financing conditions on the back of this easing will help spur the growth into the second half. And that's why the markets were doing fine in the first half. Now, there was no easing by the key central bank, the Fed, so far. For the second half, we do think there could be some easing, but the issue is that it's not going to be preemptive and proactive for the inflation falling reasons. It might be reactive and really for the reason of growth disappointing. And that brings into question the earnings delivery because the expectations are quite high for second half. So this trade-off of higher for longer central banks and easing only for the growth disappointment reason, but on the other side, how are we going to get the earnings delivery, which is expected to be very high? And then the starting point to all this is not anymore that people are underinvested or people are scared or hedged or away from the market. The starting point is low volatility, low spreads, high positioning, and that kind of models the trade-off for the equity market.
Thank you for that. What are some things you'll be keeping an eye on as we head into the second half of the year?
For the second half, we are going to pay attention to politics. The US elections will be quite critical on many fronts: trade, geopolitics, tariffs. We also need to see how the latest French elections will play out as we go through the year. And then the question is really over the leadership in the equity market. So far, the equity market was very one-sided, very narrow. The question is, will there be broadening? And we have started the year long growth style, long large caps. There are some opportunities in second half to play some of the rotations, but I think that would be important for investors, the leadership in the equity market.
And finally, what are some of the themes you will be watching going forward?
In terms of the themes, what we are going to be looking at is profit margins. Companies basically benefited from COVID distortions. Their profitability improved. Their top line was very strong. Mix was very strong. Is that sustainable? Is that a steady state? Can companies continue to deliver? Also, the credit market. So far, credit market was very, very benign, and that fed into the equity valuations. The question is that going to continue as well?
Mislav, thank you for your time and insights. Now let's hear from Meera Chandan, co-head of Global FX Strategy. So Meera, what are the key points to focus on in FX markets in the second half of 2024?
Two key points to focus on. The first one is the broad dollar. The expectation is that the dollar should stay strong, if not get stronger from current levels. The straightforward explanation for that is that the rest of the world is really not offering much in terms of yield or growth to incentivize investors away from the dollar. The dollar currently yields more than half of the currencies globally. And even by virtue of doing nothing at all, it's gaining ground because the Fed's not cutting as we speak, but other central banks are. So there is a growing yield advantage that the dollar has. And the second is that the growth advantage is also quite intact because we're coming off of very strong growth levels. Data is moderating in the US, but it is coming off very strong levels. So we shouldn't really expect to see massive amount of dollar weakness in this environment, particularly when it looks like the growth pickup outside the US is also softening once again. The latest set of PMIs from Europe, for example, disappointed, which I think the next number will be quite key. China data has also been pretty fragile. So overall, not a lot of competing growth and yield alternatives for the dollar, which is why we are bullish. As far as the second theme is concerned, it's going to be about yields compression. 80% of central banks will be cutting rates at some point this year. And what that means is that investors who were engaging in yield-seeking behavior last couple of years, carry was the main theme as a result of that. That is now going to slowly fade away. And certainly as the year goes on and as the Fed is able to participate in this easing cycle, I think that that particular effect should snowball.
Thanks for that. What are some factors that you and the FX team are considering as we head into the second half of the year?
Lots of challenges for FX in the second half. I'd say the first one is that FX usually tends to be about divergences. This year, 80% of central banks will be cutting rates. So it's really more about policy convergence, not that much differentiation. So what this means is that you really have to put a lot of effort into identifying what other drivers of currencies could emerge. And we think the growth outlook, the relative terms of trade is going to be more relevant drivers of currencies. Carry is going to recede as a theme. I think the second challenge is going to be around the US elections. That's certainly the biggest event in the second half. And I think there's a lot of uncertainty in terms of what that might bring. But it's fair to say that in certain cases, the trade policy as well as the policy on Ukraine and Russia is probably going to be dollar positive. So that's yet another thing that adds to the dollar advantage going into this key event.
Meera, thanks for sharing your views with us. And now, for a look at rates, let's turn to Jay Barry, our co-head of U.S. rate strategy. Jay, can you walk us through your expectations for U.S. rates and the fixed income markets as we head into the second half of the year?
So we think it's very important to note that the Fed's been on hold now for just about a year, and that's one of the longer on hold periods we've seen over the last 30 years. But we see a pathway for the Fed to start lowering rates in the second half in the fall because consumption is slowing, because labor markets are loosening, and we do see a pathway for the disinflationary process to return. And that has typically been supportive of yields moving lower and yield curves steepening. So I think it's important to note that we think that the peak for yields has been put in earlier this year and that there is a pathway to lower yields. We think it's more than likely that yields will be range-bound for the next few months before resuming their descent much later this year. And this really presents a challenge for investors because ordinarily, even looking at shallow raising cycles like we've seen in 1995 and 2019, yields have declined pretty aggressively heading into the first cut. Whereas this time around, we're already pricing in 150 basis points of cuts over the next 6 months. So we think it will be important for investors to choose location when they're trying to add duration, given how much is already priced in for the Fed for the balance of this year, as well as for 2025.
Jay, this is a question we're asking all of our analysts on the podcast. What's changed from the first half of the year versus the second half of the year?
So the first half of the year was dominated by upside prints to inflation, upside prints to growth, and consistent revisions higher, which brought the markets to revise their Fed forecast from a Fed that was likely to start easing in the spring and ease aggressively to now one that is likely to ease later this year. But we think that we're probably past the peak of growth and inflation revisions because we've seen evidence that consumption is slowing. And we think the disinflationary process, which had become halting in the first half, will start to resume in the second half of this year. So if the market was very hawkish with respect to its expectations for the Fed in the first half, but we expect it to be slightly more dovish for the second half.
And final question for you. What are some key themes you'll be watching going forward?
So certainly trying to get a sense of exactly how decisively the labor market is slowing, because we've seen that initial jobless claims have begun to move higher over the last couple of months. But so far, it seems that the move higher has been for more benign reasons than for layoffs. If we get a sense that they're picking up more aggressively, that might be important because it could lead the markets to price in an earlier set of Fed cuts, a more aggressive pace, and a lower terminal rate, which would probably present some downside risk to our Treasury forecast for the balance of this year. So that's one key factor that we're certainly watching. We're also watching the presidential election and the potential that it's got for the fiscal impact. And then we're watching supply and demand because the Treasury market, we think, is pivoting away from support from largely price-insensitive investors like the Fed and foreign investors in U.S. banks towards more price-sensitive investors. And against the backdrop of what is very heavy Treasury supply, we think this should lend itself towards a slow creep higher to term premium over time and higher yield curves, steeper yield curves. So we're watching supply-demand dynamics as well.
Fantastic. Jay, thanks for that.
Thanks so much for having me.
And next, we'll be hearing about international rates. Fabio Bassi, head of European rate strategy, joins us. Fabio, what are some of the key points in your outlook that you think are especially pertinent to clients?
Clients should be aware that the second half of the year will be where central bank will start cutting rates. The title of our outlook was Not an Easy Easing Cycle, indicating the challenges of central banks. However, we have more conviction in terms of the disinflation process that is taking place. What are the central banks ex-US that are going to cut this year? We expect the Bank of England, the RBNZ, and the Norges Bank to join the ECB and the Riksbank that already started cutting rates in the first half of the year. Is the market already pricing this cutting cycle? Not fully, and that's the reason why we see value in long duration. The market where we feel strongly in terms of the long duration is probably the euro area, where the market is not pricing a terminal rate in line with our forecast. In terms of target, we expect yields to move lower.
Fabio, are there any dynamics you would outline that have changed from the first half of the year as we move into the second half of the year?
The first half of the year was very sticky in terms of inflation, resilient growth. We challenged the ability of central bank to deliver the cut that were priced at the beginning of the year. But we believe that that dynamic will gradually change with slower economic growth and inflation allowing central bank to remove some of its monetary policy restriction. What does it mean? It means that we like to trade duration from the long side. We believe that there are two notable exceptions in this dynamic. The RBA will not be able to cut, in our view, until early next year. And the BOJ is on a different camp where we expect the BOJ to actually hike rates by 50 basis points this year and again in 2025.
And lastly, what are some key themes you will be watching as we head into the second half?
Well, definitely we expect a tactical trading outlook. I don't think it will be a second half of the year where people can position and sit down and relax. I think that the soft landing story, which is pretty much the baseline of our macro outlook, could be challenged by data dynamic, where some resilience in growth and inflation could make the market prices situation not dissimilar to what we saw in the first half of the year, which basically means delaying the expectation of the cutting cycle. On the other side, if you're going to have deterioration on the macro outlook or on the labor market, that could lead potentially to a dynamic where the market price an accelerating easing cycle with a faster cutting. And that would be clearly a dynamic where we need to lower our yield target for the rest of the year. I think that geopolitical tension will remain in the horizon, and that is a risk of dynamic that people should be aware of. We recently came from the election in UK and the election in France that created selectively a certain amount of tension. And this is something that people should keep an eye on going forward. Clearly, we go into a big election in US, and that is another factor that should be in the investor radar screen.
Fabio, thanks for sharing your outlook on international rates with us. And now we're going to turn to commodities. Joining us is Natasha Kaneva, our global head of commodities research. Natasha, what are the key things to watch in the commodities space as we move into the second half of the year?
Thank you for having me. So point number one is with the fear of economic growth fading, we believe that the recent pullback in commodities is just that, a pullback. So number one is agricultural commodities. Second on our list is oil. So the balance will be tightening very quickly. Into the fourth quarter, demand remains very strong, though we would have to be very explicit that majority of the move has already happened. It's behind us with 12% appreciation in the oil prices. In the third place is precious metals. It's gold and silver.
Fantastic. Thanks for that. Final question for you. What are some key themes in commodity markets that you think are relevant for clients to be aware of?
There are a couple of things that clients should be watching very closely. Number one is weather. So July has been oppressively hot. National Oceanic and Atmospheric Administration is anticipating a record-breaking Atlantic hurricane season. This is the largest number of named storms since the agency began issuing seasonal hurricane outlooks in 1998. So excessive temperatures have supersized effects on commodity supply chains. For example, oil refining, we're watching very closely what is going to happen in the Gulf Coast throughout the summer, but at the same time, further amplifying the risks to the U.S. benchmark. Oil and gas prices, nearly half of the U.S. petroleum plant capacity, natural gas processing capacity is sitting in the U.S. along the hurricane-prone Gulf Coast. And of course, droughts have very negative impact on the food supply. But outside of that, we're watching very closely demand as well. As the Northern Hemisphere barrels into summer, we anticipate demand for some of the world's most vital commodities to climb. So revenge summer travel season continues. It's very much still in place. For example, in the United States, we expect 82% of all the Americans to travel this summer. Majority of them will be traveling by car. Clearly, this is very bullish for the gasoline demand. In terms of guidance from the U.S. airlines and the international airlines, we're expecting about 6 to 8% higher travel demand this year versus 2019. So by all means, it should be a very strong demand season for most commodities.
Natasha, thank you for sharing your views with us.
Thanks for having me.
And now for a look at credit markets, Stephen Dulake, our global head of credit, securitized products, and public finance research joins us. Steve, thanks for stopping by.
You're welcome.
So Steve, what are some highlights from credit markets at mid-year?
I think the first point is that not much has changed at all, at least in terms of the broad credit market narrative. So, this idea that you have this push and pull between very tight credit spreads on the one hand and relatively attractive all-in yields on the other, I think that's fairly well known. I think that remains in place through the second half of the year. And the sort of bottom line for investors is still that I think credit offers a decent, though not stellar, return. I think as the second half of the year evolves, we will see more decompression or dispersion in markets, not least given our own macro base case that growth slows a little bit from here. And to revisit one of the themes that we had from the very beginning of the year for our outlook for 2024 overall, one of the thoughts at the time was that the sort of securitized product space looked attractive relative to underlying fixed rate corporates. We still think that's the case. We still lean into that view, though I would say at this juncture it's probably a little bit more of a low conviction lean than was the case 6 months ago.
I'd like to get your thoughts on emerging market corporates, which have been performing surprisingly well this year. Do you expect that trend to continue?
Yes, we do. So the term that we've used to describe emerging market corporates or our expectations performance this year is that they would do sneakily well against the backdrop of all this focus on developed markets and Fed cuts and things like that. And emerging markets corporates have indeed done very, very well. Two real drivers there. One, a lack of supply, a market that has been structurally starved of supply for a number of reasons, but notably in Asia, Chinese corporates have financed themselves onshore rather than offshore. Ditto Indian corporates. So it's created a big supply squeeze, if you want to call it that, in Asia. And the asset class has benefited from that overall. Secondly, we obviously know from the tragic events in Russia, Ukraine, that companies struggled. We saw a lot of defaults. Some of that is normalizing. Also, the stress that you've had in the Chinese property sector has begun to normalize. So from default rates being well into the double digits 18 or 24 months ago, we now are expecting defaults to actually be around 5% at emerging market corporates. So structural starvation of supply and default risk means EM corporates will continue to quote unquote sneakily well.
Fantastic. And finally, what's changed from the first half of the year versus the second half of the year? And what are some key factors you and your team are considering?
I think there are probably three things that I would highlight that are going to be a little bit different about the second half relative to the first half. Firstly, I think that we're beyond the point where we're going to be debating quite aggressively how many Fed eases we're going to see this year. I think the market has broadly settled on the idea that we'll see something between 1 and 2 Fed eases this year. So depending on how the high frequency data roll, I think market pricing will oscillate somewhere between pricing no Fed cuts and a maximum of 2. And I think if I look back on our first half experience, you might argue that we probably spent too much time at any one point discussing how many or how much Fed easing we would see, because credit spreads are tighter today in a world where we're pricing 1 or 2 eases than we were at the beginning of the year when we were pricing 6 or 7 eases. If we're talking about more stability in policy rate expectations, the substitute for that could be a little bit more vol related to politics. We've seen some of this recently in France. We know that the US presidential election campaign has started. The real important point there is if the debate starts to shine a light on big budget deficits and government debt levels, that can result in the correlation between rates and credit markets becoming temporarily positive. You have a big move up in rates, you have a big move up in credit spreads. So I think that's something that could be a little bit different and is worth keeping an eye on. The potential offset to that is we do think that capital markets activity, we've seen a very brisk pace of debt capital markets activity in the first half of the year. We think that can slow a bit, certainly in US high grade, where we think that net issuance through the second half of the year can actually be net zero. So that creates a little bit of a positive technicals. That could be an offset to some of this political vol or political related vol should it surface.
Excellent. Steve, thank you so much for your time today.
Thanks for having me.
Now, Luis Oganes, head of global macro research, will share his insights. Luis, what are some of the key points in your outlook this year that clients should be aware of?
So in the projections that we had for growth for the first half of the year, actually emerging markets did exceed those expectations, which is good news. However, we're seeing signs of deceleration in EM. So the second half of the year is probably going to be a bit of a slower pace of growth. However, for the full year, we still expect 4.2% 2024, which will be basically flat to 2023.
And what's changed from the first half of the year versus the second half of the year? And what are some key factors you and your team are considering?
So emerging markets has been experiencing the deceleration of inflation during most of 2023 and early 2024. But in recent months, this inflation process seems to have stalled somewhat, not too dissimilar to what we saw in the US or other developed market economies. However, there seems to be signs that the deceleration of inflation has resumed in the US. Now markets are expecting the Fed to start cutting potentially as early as September, which is actually the new base case scenario for our US economists. This should allow EM central banks that have started already cutting to continue doing so. Those that have not cut yet to start doing so. So it should be a more benign environment for emerging market central bank easing.
And finally, Luis, can you highlight 2 or 3 EM markets you're keeping a particularly close eye on and why?
There are several EM countries that have enough going for them that regardless of what happens globally, there's probably going to be interesting opportunities. And one of them is India. India, starting in June, is being included in the GPIEM local currency bond index. So that promises more inflows into the country. Yields are relatively attractive. India is potentially going to be attracting some of these flows that are going to be diversifying away from China. And certainly the changes in the global geopolitical waves will also favor India. So this is one country that we're paying a lot of attention to. We do have a couple other countries that are in similar situation. One is Turkey. This is a country where there's a shift to monetary and fiscal policy orthodoxy that is starting to yield results. Inflation is coming down, and this hopefully is going to be generating in the months and quarters ahead more of a virtuous circle in which lower policy rates eventually later this year and into next year is going to be supporting growth. And then in the US, America's time zone, Mexico is the one country that does garner attention. There's a new government in place. There's open questions as to how President-elect Claudia Sheinbaum is going to be. But certainly Mexico stands to gain the most from the intended continued decoupling of the U.S. economy from China with this reshoring, friendshoring of investment flows. So I would say that we'll point to these 3 countries as the countries to watch in emerging markets in the second half of the year and into 2025.
As we wrap up today's podcast, let's now turn to Tom Salopek, our head of cross-asset strategy. Tom, how are things looking across asset classes?
Well, on my side, I cover the 3 to 5 year capital market assumptions for cross-asset. And what I'd say is the cross-asset trade-offs has worsened with the stock year-to-date rally. In general, expected returns are worse. And if we put it into a multi-asset portfolio, we're looking at something that resembles a late cycle portfolio. At the same time, if we look at the dollar maybe looks overvalued on a rear valuation basis. But in the near term, what you have is that U.S. exceptionalism, interest rate differentials, and U.S. election risk, which may be supportive for the dollar. But I think whether we're talking about stocks and the recent stock rally or we're looking at the dollar, one of the things we think about as we try to build a bridge from tactical to strategic is that it won't necessarily be a straight line, given that in the case of the dollar, the positive momentum can continue before our bearish view is realized, and similarly for the U.S. dollar as well.
What are some things you'll be keeping an eye on as we head into the second half of the year?
For a while now, we've been ping-ponging back and forth between soft landing and high for long. And what the second half of the year will do for us is clarify why we'll be cutting interest rates. And I think that's a very important thing because as we look at the historical examples, what you see is that when you're cutting for growth risks, stocks go down. When you're cutting for soft landing, as you did in the mid-1990s, stocks sailed right through that rate cutting cycle. So it's very different implications. I'd say there's some meaningful differences between the 1990s in the sense that now the yield curve has been heavily inverted, pointing to growth slowdown, tough times ahead. But at the same time, that signal has not worked. And we don't think it's a matter of that signal won't work, but it's a matter of we've had supports that have extended this cycle. Cash cushion, strong jobs market, and kind of monetary policy transmission that's been a bit delayed with companies borrowing at fixed rates. In the case of these comparisons with the 1990s, they're not perfect comparisons in the sense that whereas now the yield curve is inverted, if we go back to the 1990s, the 94 hiking cycle, the yield curve never inverted. And when we look at the picture in the ensuing period, what you see is a much stronger cyclical picture than we have right now as we look at a growth slowdown, which will be challenging for consensus earnings estimates.
And finally, what are some questions that investors should be asking themselves going forward?
Well, there's two things I'd highlight, and maybe one is a longer-term issue than the other. So the first one is how much diversification do you get from bonds? Historically, bonds should act as the cushion for stocks. With the hiking cycle and rising rates, what can happen is all asset classes go down, producing a positive correlation from the hiking cycle. That's where we have been. As we go forward, the issue for us, it may be less about rising rates and more about growth risk. That points to correlations normalizing and return to our normal negative correlation between stock and bond prices. So if we have a worry about bonds, it's not so much that the correlation won't be the right way around. It's more a matter of with an incomplete hiking cycle, we don't have upside for bond expected returns as much as we thought we might have had.
Fantastic. Tom, thank you so much for joining us on the podcast today.
Thanks so much for having me.
That wraps up our Mid-Year Outlook episode here on Research Recap. We hope you found the insights from our analysts helpful and insightful, and we want to thank you for tuning in. For more market insights, visit jpmorgan.com/research.
Thanks for listening to Research Recap. If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, Google Podcasts, and YouTube. This communication is provided for information purposes only. Please read JP Morgan research reports related to its contents for more information, including important disclosures. Copyright 2023, JP Morgan Chase & Co., all rights reserved.